Do you know that Lehman Brothers was a large financial company in the United States that went bankrupt in 2008 and was one of the key events that triggered the global financial crisis? After 2008, the United States was left in disarray, with everyone questioning how such a collapse could happen. Indeed, why did it go bankrupt? First, let's get to know Lehman Brothers. Who are Lehman Brothers? Lehman Brothers is a large investment bank in the United States, founded in 1850. It played a significant role in the financial market both in America and globally. The company performed various functions such as investment in stock and bond, financial consulting, issue debt security, buying and selling real estate, and derivatives. Lehman Brothers was an investment bank that had been established for over 150 years, but faced problems due to investment in assets related to subprime mortgage, ultimately going bankrupt with debt exceeding 600 billion, marking the largest bankruptcy in United States history. It started from. In 2003, Lehman Brothers invested in a real estate mortgage company, BNC Mortgage and Aurora Loan Service, offer loans to those with low credit. In 2006, they made a profit of over 4.2 billion by securitizing the loan and selling them to investors high risk. In 2007, the stock price rose to $86.18 million, but the stock price fell and the number of defaults surged to the highest level in 7 years. The CEO confidently said that it was an acceptable risk and created a primary collateral debt obligation product for sale, which is a credit default swap. Credit default swap is a derivative used to hedge against default risks. Next, Bear Stearns Bank collapsed, leading Lehman Brothers to lay off employees and reduce branches in Aurora amidst a declining market. Lehman Brothers held the most shares, and the value of their accumulated MBS shares reached $85 billion. When the market, including MBS, start to recover, Lehman Brothers should have sold off to reduce their portfolio, but they did, and they had a borrowing limit of 31 times, meaning they had more debt than assets. After Bear Stearns, the second largest shareholder, went bankrupt.
And what happened after that? When the stock price plummeted, they raised funds but still incurred a loss of $2.8 billion. The stock price then dropped by 77% when the news spread, and it fell immediately. CDS surged to 66% as investors believed that Lehman Brothers wouldn't survive. So they sold all their shares, and short-term creditors have also reduced the loan limits. In the third quarter, a loss of $3.9 billion reduced credibility, and investors completely withdrew their shares. Barclays and Bank of America agreed to buy shares of Lehman Brothers, but were unsuccessful. This led to the bank declaring bankruptcy on September 15, with stock price plummeting by 93%, and after Lehman Brothers filed for bankruptcy, its headquarters in New York City was acquired by Barclays. Lessons learned after the collapse of Lehman Brothers. 1. Inadequate risk management. Lehman made significant investment in high-risk assets, like comprehensive risk assets, and did not have contingency plans. 2. Excessive leverage. The company had a very high debt-to-equity ratio, which led to rapid liquidity issue when assets value declined. 3. Lack of transparency. Communication Lehman financial reports did not reflect the true this. And what should we do? 1. Strict risk management. Financial institutions must have a systematic risk assessment and management system. 2. Increase transparency in information disclosure. There must be disclosure of the true financial status and risk, and accounting must be improved to reflect a more accurate overall picture. The situation in 2025 may not see a collapse like Lehman Brothers, which made risky investment without caution. The tax policy change from Trump administration caused a contraction in the global economy and seemed to initiate a trade war. The decision to implement global tax hikes for the benefit of their own country has affected global confidence. Thailand, being a small economy, can only observe and following along. However, the United States and China, with the largest economies in the world, will truly determine the global economic direction. Both events reflect the impact of economic or political decisions that directly affect the global system.